What if millions of investors are quietly paying 3 times more than they need to for the exact same investment? That is the strange story of SPY, the most famous exchange-traded fund on the planet. SPY is the SPDR S&P 500 ETF Trust. It was launched back in 1993 by State Street Global Advisors, which makes it the very first exchange-traded fund ever listed in the United States. When you buy one share of SPY, you are buying a tiny slice of 500 of America's largest companies all at once. Today, SPY is enormous. It holds well over $750 billion in assets, and on a typical day, it is the most heavily traded fund in the entire world. When big institutions want to move in or out of the stock market quickly, SPY is usually where they go. So how does it actually work? SPY simply tracks the S&P 500 index. As the value of those 500 companies rises and falls, so does the price of SPY. You get instant diversification across technology, healthcare, energy, and finance without ever having to pick a single stock yourself. Over the past year, that basket returned roughly 21%. But here is what they don't tell you. SPY charges an expense ratio of about 0.09%. That sounds tiny, and it is. The problem is that two newer funds, Vanguard's VOO and BlackRock's IVV, track the very same 500 companies for just 0.03%. That is roughly 1/3 of the cost for an identical index. Why does that gap even exist? SPY was built in 1993 using an older legal structure called a unit investment trust. That structure has rules that stop SPY from immediately reinvesting the dividends it collects, which can create a small drag over time. Its competitors were designed decades later without those constraints and priced aggressively to win new investors. So does the higher fee show up in performance? Over long stretches, SPY, VOO, and IVV post almost identical returns because they own the exact same companies. The main difference is the fee and a whisper of dividend drag. For a long-term buy-and-hold investor, paying more for the same index is simply money left on the table. Then who is SPY actually for? Its real superpower is not cost, it is liquidity. Because SPY trades in such gigantic volume, it has the tightest and most active options market of any fund out there. Traders, hedgers, and professionals love it for exactly that reason. If you are moving large sums quickly or trading options, SPY is often the better tool. Here is the honest reality check. SPY is a fantastic fund and a genuine piece of financial history. But for a simple long-term investor, a cheaper clone tracking the same index will usually leave a little more money in your pocket. If this helped clear things up, do me a favor and hit that like button, and subscribe for more plain English ETF breakdowns. And I want to hear from you in the comments. Would you pay a slightly higher fee for the original, or switch to a cheaper version that holds the exact same stocks? Let me know below.